So good morning, everyone. I'm Alistair Pym, the VP of Innovation and Partnerships here at ACT, the Alliance for Climate Transition. And I'm happy to welcome you to this webinar today, which is all about managing in a time of change and what it means for business and policy. So as I'm sure you know, federal policy has been shifting and it's creating challenges, but also opportunities for businesses. But not only for businesses, but also for municipalities, for states, and I think the climate economy as a whole. So this morning, we're going to talk about how mission-driven leaders can adapt and succeed in this new, rapidly shifting environment. And to help me do that, I'm joined by three experts in this space. So we're also longtime partners of ACT. So grateful for their support and also their expertise. We have Katie Burke, who is from Marsh, Tom Burton, who's from Mintz, and Kenyon Wilhoit from PwC. And I'm going to ask them later to spend a bit more time introducing themselves in more detail. I also wanted to thank our additional sponsors, our state partners from our region in the Northeast, who've done so much to help promote this webinar, but also really make a lot of progress in their states in the region. And that is Clean Energy New Hampshire, the Maine Renewable Energy Association, and Renewable Energy Vermont. So thank you to all those three. So for those of us working in the climate economy and the climate transition, the environment is shifting, as I said before. There are some subsectors which are seeing more opportunity, but in general, there are a lot of headwinds out there, and there's definitely more uncertainty. But at the same time, climate change is happening all around us. So the urgency for change remains. So back on July 4th, the president signed the One Big Beautiful Bill into law and then followed it up with a few days later with an executive order. So we're seeing phasing out of incentives, lots of rule changes, impacts on the supply chain, due to more rules around foreign entities of concern, and lots of details. And that's why I'm really happy to have our experts on the call, because I'm going to begin by asking them some questions. And then I will be also leaving time for questions from the audience at the end. So you can put your questions in the Q&A box, and we'll be looking for those around about 22. We are recording this webinar, but we hope you'll stay throughout and ask questions at the end. And with that, I would like to start by asking all of the panelists to introduce themselves, starting, I think, with Tom, and then Katie, and then Kenyon, and to spend a few minutes, not only to introduce yourselves, but also to take a few minutes to tell us what you're seeing out there from your perspective. So, Tom.
Great. Thanks very much, Alistair. It's great to be here in this time of challenge and opportunity, as you said. For those who don't know me, my name is Tom Burton, and I'm the chair and founder of Mintz Levin's Sustainable Energy and Infrastructure Legal Practice. So we focus on finance, M&A, working with companies and investors from the very beginning stages of their life cycle, technology licensing, for example, through venture capital, private equity, and project finance. So scaling those technologies into full-fledged, very impactful businesses. We've been doing that for over 20 years. Our team is one of the largest in the United States. For example, over the last 2 years, we've done 150 deals at $7.5 billion in deal value. One of our larger clients is the Loan Program Office of the Department of Energy. So we have some insights on how policy is shifting in connection with the new administration. So in terms of framing and coming off of Climate Week, actually, this last week in New York, we had quite really the largest gathering, I think, in the U.S. of climate-oriented investors, entrepreneurs, and utilities and others. We had many meetings as a team with administration officials and others, and I think got a very clear understanding of why we're seeing what we're seeing in the One Big Beautiful Act, for example. And much of this at a high level really relates to a policy shift toward making sure that the U.S. has adequate base load power. So baseload power traditionally, been provided by coal and natural gas. Increasingly, there has been a plan for renewables with support of the federal government to be a part of that. We're instead seeing a return to some of the more typical policies focused on building out baseload in reaction to unprecedented, or I shouldn't say, at least in the last 40 years, unprecedented demand for energy at that level through digital infrastructure requirements and others. There's also, by virtue of the natural resources available in the U.S., coal. I'm going to stay away from coal, but natural gas, certainly, and oil. There is the opportunity for the U.S. to play a larger role globally in global economics, and I think that is part of the policy shift. It's to provide, for example, LNG exports, et cetera, to Europe, places where their energy security is critically important. It is here as well, but critically important there. Reducing reliance on places like Russia and China for those resources. And so this economic / energy security policy is part of also what is driving this return to focus on baseload power. Now, the rules from an opportunities perspective that have come through create tremendous opportunity in still nascent technologies like geothermal, the resurgence of nuclear, and then a few other pockets of opportunity, meaning that tax policy has been retained to promote those technologies. And then finally, a reason for some of the pushback on solar and wind is that, as many people know, just about all of the generation that's been built in the United States in the last couple of years, or is on the queue to be built in the last couple of years, has been solar and wind. And so as an intermittent resource, it's left the baseload resources behind effectively. And so with increased demand, there's concern that with all of that intermittent resource, we may not be able to meet baseload demands. So thus pushback on wind and solar to ultimately shrink the generation that is occurring in that space to allow for more infrastructure and building of generation at the baseload level. So that's what we're seeing, and that's what we have to react to and build from there.
Thank you, Tom. Great perspective. Katie, what are you seeing?
Perfect. Thanks, Alistar, and thanks for having me. For those of you who don't know me, I'm Katie Burke. I'm Marsh's North America Renewable Energy Leader. And for those of you who don't know, Marsh is the largest insurance broker in the world. And we organize ourselves based on industry just to be able to specialize on the industry-specific challenges that our clients face. So our energy and power practice in the U.S. Is also the largest in the space. We have over 900 clients, and we represent about 50% of all the operating renewable energy projects here in the U.S. So how we really focus on working with our clients is, yes, we do insurance placement, and that's in transferring the risk where it's appropriate, but we also really work to be a strategic partner with our clients and help them manage their risk from a holistic perspective. And given our market presence, we really do have a good pulse on the market and where organizations are moving, given all of the recent changes in the current landscape. So a few things to address, obviously, with OB3, as I call it, because I have a hard time saying it's beautiful, just because of the sunsetting of the credits under the IRA, as well as the tighter timelines and then the FEOC restrictions. And we're seeing a lot of our renewable energy companies, they're rushing their construction timelines right now. They're trying to take advantage of all of the development work that they already have, the assets that they already have under their purview, and capitalize on that right now. They're also taking a really, really deep dive into their supply chains and try to understand alternative options to avoid those FEOC restrictions in order to be viable in the future, moving forward after the December 31st, 2025 timeline there. Again, very similar to what Tom was saying, we see a lot of our clients looking at other power generation sources as well, so natural gas and BESS specifically, just given where the demand is and the different opportunities given the economical standpoint from these project developments. And then we've also seen a huge increased emphasis on trying to free up the capital using different strategies like tax insurance, surety, and credit solutions, just given the landscape and the challenge that renewable energy projects do have, given their tight margins. With the sunsetting of those tax credits, they're just trying to make sure that they have some free capital to use there. again, similar to what Tom was mentioning, with the demand that we're getting from AI and that emphasis on energy dominance and security here in the US, the other part of it that I think might be a little bit conflicting to Tom's point, but overall, we do need energy generation right now, right? So the one thing to point out is that renewables are deployable in the near term within the next 1 to 2 years, where we're seeing other generation like natural gas and nuclear, which will be obviously picking up very quickly, but those will take 5 to 10 years to construct. So we are still seeing a lot of that being pushed forward. Excuse me. But yeah, I think the other part of it is that we're looking at a lot of clients looking to co-locate for data centers and use the advantage of having battery energy storage system to really create that reliable power.
That is a very helpful perspective. Thank you very much, Katie. Good coverage. Kenyon, what about you? What are you seeing out there?
Yeah, thank you, Alistair. First and foremost, thank you, ACT, and thank you, Alistair, for hosting the webcast today. It's great to be on with Tom and Katie. I will try to echo some of the comments that Tom and Katie made, add a little bit of a different flavor. My background and where I come from in PwC is within our deals group. I focus specifically on the power and utilities, renewables, and infrastructure side of our business. My specialty is on the valuation side, but I work across our deals platform. So with my financial due diligence, accounting advisory, M&A tax, and valuation colleagues. I think where I typically like to start these conversations, particularly with the huge surge of demand growth that we're expecting now, but also in the coming decade, is looking back to, say, the late 90s, early 2000s. I think there's a lot that we see within the power industry that's cyclical. I started my career in 2004, and so it was just at the tail end of what was the big merchant build out in the late 90s, early 2000s. And so when we were sitting in those power markets, we were in a need for additional supply to be added to the market. We had a number of independent power producers being developed, really racing to supply that additional power generation to meet that need for additional supply. And what ended up happening is we had two developers on each end of the street. Both would look at each other and say, I don't think the other one's going to build. And then what happened is both built. And so we very quickly found ourselves in a very oversupplied power market in the US. That led us to the merchant crisis and bankruptcies and restructuring work through the 2000s. And we really climbed our way out of that oversupply situation through natural demand growth. We climbed all the way out until we had the financial recession, which then put us in, back into a little bit of oversupply. But we've been in primarily an oversupply power market for the last 20 years. The opportunities within the power industry has really been opportunistic. Clearly, there was a lot of emphasis on clean energy and the promotion of state renewable portfolio standards and other things to promote additional new builds. And while it may not have been necessary from a supply perspective, it certainly was necessary from a standards perspective. And so we saw a lot of development of renewable over the last decade to 15 years. And that's really been the focus. We've had some support in the industry, obviously, with the Inflation Reduction Act that really changed the way we viewed development over the course of the coming decade. And so I think when I was discussing the Inflation Reduction Act in years past, it was really the change in the way that we saw the industry approaching renewables. And so instead of just looking at a 1 to 2 year race, it was looking at a 10-year horizon. And so really being more opportunistic and strategic with capital. So having a 1 to 2 year plan, having a 5-year plan, and having a 10-year plan. And as I sit here today, Alistair, really what we're kind of thinking about is what's the opportunities and what are we seeing in the market? I think with the One Big Beautiful Bill coming in place and a quicker phase out of a lot of the tax credits, particularly for wind and solar, the focus is really on that short term again. And so we see a lot of clients looking at that 1 to 2 year plan. How can we invest quickly? How can we look at some of those projects that maybe we were looking at in the 5-year plan or 10-year plan and speed those up? And how can we most efficiently utilize our capital in the next 1 to, say, 4 years, depending on safe harbor? As well, we're now in that situation where, just like in the late 90s, we have a need for supply. AI, cloud services, quantum computing, all of this is going to drive a huge amount of demand in the coming years. And so we're going to need to add a lot of supply to the mix. We're seeing some big mega deals in the course of the last year with independent power producers buying large generation portfolios to help position themselves to supply power to some of this increased demand. But as Tom and Katie mentioned, there's a need for additional supply. And so how can we do that most efficiently with both base load, as well as doing that with resources that can quickly be put on the grid, such as renewable?
That's great. So some very interesting sort of overlap, but also some different perspectives there. So that's helpful. You've started to sort of say that you're seeing some things happening, and you sort of hinted about what you're seeing your clients do. But for the others who may be not quite so quick, what should your client companies be doing now and over the next 6 to 12 months? So you talked about short term, and Tom, if you could start that off, please.
Yeah, sure. I'll try to be as granular as I can be. There's really a lot going on. The short-term rush, obviously, to try to get to construction is clearly key. There are a few things that, from a practical perspective, folks can do. One, because the 5% safe harbor goes away with respect to solar and wind. You will need to be very carefully documenting your physical work to make sure that it satisfies the physical work test that was recently came down from the IRS. So there is this need to look fresh at the things we're doing, and then try to be creative about perhaps the purchase of tangible assets, which might apply to a variety of projects, so you can try to qualify multiple projects. You also are going to need to audit your supply chain, it looks to me, and that goes to not only us lawyers doing reps and warranties and covenants and contracts, but also actually doing those kinds of audits, in part because we don't know what those foreign entity rules are going to ultimately be. We have some sense, but that's still a risk that's out there for us to deal with. And then trying to avoid whatever delays may be out there by way of permitting, interconnection, et cetera, if at all possible. We could use some overhaul on the interconnection side. The FERC queues can be incredibly long and can be quite a bit of risk. And then I want to thank my tax team, Greg Benson and Helen Wang. They recently came out with a paper, on a number of these, incentives, how they've shifted what qualifies, what doesn't, and they're closely monitoring the IRS guidance. So we would, of course, tell our clients, please keep monitoring the guidance. We'll keep, sending out information as we learn it.
That's helpful, Tom. And just a quick follow up. So that guidance goes out to your clients, but do you publish that more broadly as well, or should? Yes,
we do. Yeah, we do alerts that can be found through our website, and we try to do other connectivity with you guys at ACT and see what try to make those resources available to everybody. Yeah.
Thank you. Yeah, great. Katie, what about you? Do you see some different things out there? What advice would you give to people?
Yeah, absolutely. So I think, very similar to Tom, but I would say with a twist from a risk management specific perspective, one thing that I would definitely encourage clients in this space to do, especially given the current landscape and what I've been seeing, is with the rush to begin construction and meet all of those requirements, as Tom was just mentioning, one area that needs to not be forgotten is the risk management side of things. So with this rush, a lot of demand on quality EPC contractors and making sure you're using good materials, resilient panels, for example, is going to be critical. So the idea of having that short-term focus on the 1 to 2 years to make sure that we can build these projects, meet that demand, and capitalize on the investment that's already been put into the industry, but also having that long-term view as far as being able to build these resilient projects that can withstand and actually be efficient in operating for the lifetime of the intended project. And that's where it's going to be, an investment for the project to be viable, for the full 35 years. If you have these projects that are going to have claims due to different considerations completely outside of what we're talking about. For example, natural catastrophes, having that loss is going to be more economically detrimental than losing the tax credits. So I think making sure that you're keeping that forefront of mind right now. The other side of this is we're seeing a lot of clients look to different solutions like behind the meter projects just to meet the data centers and the digital infrastructure demand. And while that, is a fantastic solution to kind of get around the interconnection queues and proceed with these projects, we need to look really carefully at the contractual obligations that are being put and implemented on these projects. What does the PPA requirement look like? And then also, the exposure to third parties there. So from a perspective of third party property damage, bodily injury, and certain things like wildfire liability are continuously becoming an issue in this area for our energy and power clients. And we just want to make sure that that's not being lost in all of the flurry of the day-to-day that we're seeing right now.
Okay, so some really good thoughts on what to look out for from risks. So thank you. Kenan, do you want to add anything to this session, or can I ask you the next question?
Yeah, I think for this piece, Alistair, I think the only thing I would add on top of what Katie and Tom discussed is I do think there is, again, while I looked at the Inflation Reduction Act as a way to sort of view that short-term, mid-term, long-term, specifically around renewables and some of those advancing technologies, I feel like now we still have that same sort of mindset where we need to have that 1 to 2 year focus of really how do we get the projects that we have in hand to completion so that we can meet, what are the phase down targets and the, credits expiring. But also we're having a lot of discussions with just everyone, right? In terms of how do we get involved and how do we find our niche? And so I think in the short term, a lot of companies need to figure out where are they going to play. So are they going to be the developer? They're going to build the projects. Are they going to maybe be the EPC to help with that side of the business? Are they going to be the financing or sponsor capital? There's a lot of interest in being a part of this huge amount of demand growth from a lot of different players, right? It's not just strategics in the market. It's all the financials, the PEs, the infrastructure funds. It's inbound, right? We have lots of inbound investors that are interested in the US power markets. So I think the only thing to add to I think what Tom and Katie mentioned is figuring out what the niche is going to be and where you're going to play in this growth so that you can position yourself, start to think about, do you need to do deals to try to find, those capabilities to be able to maximize your returns as part of this growth.
Right. So you talked earlier as well about how companies are thinking about how they're investing. So, companies have got capital, they've got to decide where they're going to use it. So you started that conversation, but what else do you think is changing in how companies are deploying that capital? Is it about changing sector or is it about changing other things?
It's interesting. We see a few different things. I know, Alistair, when we were doing some of the prep, we were talking about repowering and that being an opportunity that we see a lot of. And so maybe I'll fit a bit of that discussion in here. There's a few different ways that folks can really approach the market, and they could go and look at deals. So they could do deal activity, which is something I support a lot of our clients with, and look at big transactions as a way to bolt on capabilities or enhance your platform so that you are positioned strategically to take advantage of what's upcoming. And we saw that with a bunch of these big mega deals, right? With independent power producers going out and buying larger portfolios of generation assets to give them the opportunity to be a good support, source of supply for a lot of this demand that's upcoming, and purchasing those portfolios at what is, less than new build. A lot of these portfolios are, more advanced natural gas fired generation, and most of them are uncontracted. And so you have this opportunity to provide that source of supply. On the other side, there's a lot of organic capital investment. So there's big portfolios of assets that are already held with these companies and big renewable portfolios. And the IRS provides the opportunity for those with existing assets to re-qualify for tax credits if you can pass what is called the 80/20 test. And the idea of this 80/20 test is if you had, say, a wind power facility that was 20 years old, it's aging, it requires a fairly significant investment, you could invest to put brand new equipment on that existing wind farm, say reuse the substation, the collection systems, the foundations, maybe the tower, but replace the nacelle at the top. So the major components of that wind turbine. And if the investment is 80% or more of the fair market value, then it's considered a new facility in the eyes of the IRS. And so we've seen a lot of activity on that side. And particularly with this shorter term focus, those opportunities may be something you could get done quicker in a quicker timeline. So you can reinvest to get the most efficient, newest technologies on these sites that have really good wind resource, or even on the solar side, we're seeing that as well. So there is opportunities for organic capital investment as well. And I think we're seeing a lot of clients take advantage of this to invest, and to be able to invest without getting in, as Katie mentioned, those interconnection queues, without having delays in these programs, particularly with the phase out and the expiration of the tax credits in the shorter term. You can look at these projects, make an investment decision, and not have to wait for a lot of approvals. It's really, if you have access to those turbines and you have access to the equipment, then you can make this investment opportunity happen. But I do think there's not a one size fits all, right? It's a look at your organic capital investments. What can you do quickly? What other sort of new build projects or greenfield projects do you have that you could potentially push forward quickly? And then as you position yourself for the mid to longer term, it's what additional capabilities do we potentially need, or where do we think we're going to have the best opportunity to play in the future growth and demand? And do we need to look at the deals market to potentially add those capabilities?
That's helpful. Two quick follow-up questions. You mentioned kind of blades and nacelles, but what about software? Can that be included?
Yep. So it's pretty much anything within well, for wind in particular, it's the wind turbine is where the test is held. But
Okay.
for that, it's foundation it up, and usually the software is part of down tower. And so you can include sort of software as part of that. And usually there are the software upgrades. So I think as part of repower, the advantage that you have is you're reusing a site, which is aging. There's a lot of investment that's probably needed to continue to have that operate, but it's older, say 20-year-old technology. And there's such a big advancement in technology over the course of the last 20 years that if you're putting new equipment onto that site, you're going to get the advantage of larger turbines, more power being generated, lower O&M, and extension of life. So there's a lot of advantages to that. Alistair, as you mentioned, you could do those upgrades to potentially increase the power output.
And then that's helpful. Thank you. So the other question I had was, you said that companies should think about what additional capabilities they might want to be able to play in this shifting market. And you said maybe they should go to the deals market, which to me implies that they're thinking about an acquisition. But what about partnering? Are people considering partnering? Would you advise that? Does it come with different risks?
Yeah, I do think we are seeing that. To try to, provide an adjacent or comparable. When there was a big investment opportunity with offshore wind, we obviously saw partnerships and JVs become a much more important way of doing that, because there was such a big capital investment needed for those projects that firms wanted to, or companies wanted to spread that across multiple companies as opposed to just one. I think in the current market, we haven't seen as many partnerships or JVs yet. But Alistair, I think we will. Clearly, we're going to see a lot of different capabilities needed to, say, build a data center. It's not just a technology company. There has to be the power aspect of it. There's going to be EPC providers that need to build this infrastructure. There needs to be a lot of capital investment. So there's going to be a lot of financials that could participate or be a part of that. I don't know exactly how that's going to look structuring wise, but I certainly could see partnerships or JVs being, a potential way for us to do that as well.
Thank you. So I've given you a lot of time, but Tom, Katie, anything to add to that part of the conversation?
Katie, do you want to go?
I don't have anything off the top of my head. So Tom, if you have something.
Sure. Okay. Maybe in the same theme, right? One of the challenges we're seeing is that for those folks who have assets that are, have a clear line of sight, either already generating or clear line of sight, they're they may be trading at a premium, right? So there's opportunity, for capital to come into that part of the world. For those who aren't, or who have portfolios that are, still under development, cash preservation is a big piece of the challenge, and we are unfortunately seeing some of that in terms of restructurings, where these developers are, looking at, their employee base. They're looking at, really everything about their financial model and trying to sort out how can we continue forward, and meet some of these new requirements, and preserve the money we do have, dedicated to these activities. So it creates an opportunity for private capital to step in, and I think that's, really where some of the real big opportunities are. So you may be able to get assets if you have a bit of risk appetite at a pretty good price. And so that's going to be a really interesting potential opportunity for those who have an appetite for risk. I'm also curious in thinking that for those who had combination projects under development, particularly early stages, say solar plus storage, whether there's opportunity to just simply, shelve the solar piece and then go straight to storage, so there may be some interesting business model or business changes that we see occurring in the development markets as well. And then cash, private capital that would come in behind that. Coming out of Climate Week, it was very clear that there is a substantial amount of private capital available and, and willing to invest, but only as we create a bit more certainty, in these markets.
So the other thing that strikes me, I brought up partnerships, but the other part of my title is innovation and sort of creativity. So do you think that these shifts open up an opportunity for sort of more innovative solutions, or is there too much risk in there? And I point that to anyone.
Well, I'd say there's always opportunity to innovate. I recall, there's, innovative financing solutions, for example, that had come into the fore coming out of, the interconnect queue, problem that we've seen, and so there'll be companies that could take advantage of the opportunity to, deal with the audit trails and all of the new information and detail that has to be gathered and confirmed and verified in order to qualify for credits, right? In a way that perhaps, wasn't part of the mix before. So you could see tech companies, software businesses, AI really playing a role, blockchain playing a role in that world. So there's definitely that as an option. We may also, without tax credits, then you've got to pencil out the financials on solar better. Maybe that, creates a bit more innovation focus on, how to improve, module or cell performance in ways that, perhaps were somewhat shelved in the past or in the last recent years. So it could create, a focus on that as an example. So I could certainly see some focus there. One thing that was preserved coming out of this new law was, ARPA-E. So we saw a lot of reduction in the LPO office, loan program office, and in the DOE support of projects. But the ARPA-E group, which is the innovation group, I think maintained their entire budget, albeit quite a bit smaller, but the signal being we want to support innovation and technology in the energy sector broadly.
Good to hear. Yep.
Yeah, and
Yeah, go ahead, Katie, please.
Sorry. Sorry. I just was going to say, definitely on the innovation side, we're going to see that continue to move forward. One, renewables, has been that industry that has faced a lot of challenges in the past and continues to innovate as far as technological advancements and making, new chemistries, for example, on BESS, and continue to push that forward to make it, one, more effective, and two, more cost efficient. On the risk management side too, when it comes to, preserving that capital or having more deployable capital for these companies, there's a lot of innovation on the risk management side to help push that forward as well. So different areas, for example, we have a product called the Interconnection Security product, which is essentially a surety product that's a LC, or it's a surety-backed LC to help companies that are in the interconnection queue not have to deploy as much security for that position and help free up capital. That's just one innovation. There's others out there just to help one, protect that investment, but again, make sure companies have that free capital to reinvest into other projects.
Excellent.
And
Good.
Alistair, I can just add on to Tom and Katie's comments. I think the short term, we certainly are still seeing kind of the focus on the technologies that we'd expect, right? Natural gas for base load, renewable, either wind, solar, battery to supplement. And then a lot of that is what we're seeing in terms of kind of the plans around, if you're going to do self-supply for data centers, and if it's going to be sort of behind the meter or self-supply for those, it's probably a subset of that, at least in the short term. I think the other piece of innovation that we do hear a lot of clients and the industry talking about is nuclear. And so there is a lot of emphasis on nuclear. There's a lot of emphasis on, can we get to small modular nuclear that is economical and makes sense? And there's a bit of a longer runway around that. And so I do think that's something to look out for as well, is that there likely is more opportunity for investment around additional nuclear, potentially in the mid to kind of say 5, 10, 15-year time frame. And can we get that more economical based on further deployment? But there's a lot of focus there. Clearly, that would be a really good resource from a baseload perspective to supply a lot of this power need. But in the current market, obviously, natural gas, wind, solar, battery are going to be quite a bit more cost effective.
And we are home to one of the leading fusion companies as well. So what do people think about the potential for fusion in that same time range as you mentioned for small modular nuclear, 10 to 15 years? What are your bets there on fusion?
Oh man, that's a hard one, right? Because we've been talking about fusion for a long time. It would be fantastic if we can get this again economical. Do I think it has more potential in the next 10 to 15 years? Absolutely, because there is continued support. And because of the demand growth, that will provide the need for power. So do I think is it possible? Absolutely. Am I going to bet on it? I don't know, Alistair. That's a really hard one for any of us. But I do think there's a lot more emphasis that this could be the time that we get more investment and maybe we do get more economical there.
Excellent. So you talked earlier about there's challenges, but there's opportunities, and you mentioned a few of them now. But what do you see as the sort of biggest opportunities out there that are popping up recently and going to be there for the next few years?
I can start. I'll save Tom from having to go first on all of these. But yeah, I mean, clearly the demand growth is the biggest opportunity right now. It's the huge amount of demand growth that we expect over the course of the next 5, 10, 15 years. There's a lot of different forecasts out there from, different consultants. But if you look at AI, cloud services, quantum computing, what that makes up of the total power demand in the US, we're at maybe 2 to 3% of overall power demand. And that's expected to grow in the next few years to 7 or 8%, depending on how quickly this happens. And so there's a huge amount of power demand growth that's going to happen in the very short term. The hardest part are all the things that Tom, Katie, and I have kind of highlighted throughout the sessions, which is, how do you get approvals? How do you build brand new and get through interconnection queues, get through permitting, get through all of that process quickly to be able to provide that power and put that power onto the grid as quick as possible. So that's the challenge, but the opportunity is that demand growth. There's so much investment that's needed. There's so many dollars that need to come into place, and it needs to be from all parts of the sector. It's strategics, it's sponsors, all of those folks determining what projects they're going to build, how they're going to build them. It's the financials coming in and providing the capital to get this done. And that's the innovation side, like you said, Alistair, to get creative and how do we supplement this power longer term, but more short term, right? How do we get this stuff done quickly? And I think that's why we see a lot of focus on deals for power generation that's already on the grid, but also a lot of emphasis around projects that can get through that interconnection queue quickly. The one area that I don't think we've talked about yet, but I'll just put out there is, from the technology companies, we are seeing a lot of deals right now for land that has access to power. There's a huge premium being paid on land that has access to power. And the reason is because you're going to get to market faster. You're going to be able to build your data center with that access to power, and it's worth a heck of a lot more in the land that doesn't have access to power. So power is at a premium at this point in the market. So it is a big opportunity in terms of that demand growth. But Tom, Katie, I'm going to turn to you guys.
Yeah, I'll just add, I think one area to, on top of that, Kenyon, because I completely agree. Obviously, the demand is going to be the number one driver here. But another area that we're seeing a lot of opportunity, given the supply chain challenges, are domestic manufacturing and bringing those capabilities to the U.S. to meet that demand. And then the other area that I think is, almost implied with a lot of these conversations, but sometimes is skipped over, is the infrastructure upgrades that are going to be required to actually, transmit and distribute that power that's needed. So those are two areas that we're seeing a lot of focus on, kind of behind the scenes here.
Yeah, absolutely. And then there'll just be more baseload infrastructure being built out as well. We'll see, we know federal lands are being dedicated to more generation. There'll be more pipeline, construction, all of which needs, permitting reform and, interconnect reform in effect at the FERC to realize on that potential. I do just want to Kenyon's point on digital infrastructure. That to me is most fascinating because you're really talking about the confluence of technology and power, enormous amounts of capital. Almost, it's really hard to conceive, wrap your head around it. That's being required to drive, AI and data center growth at the same time. The power needs are critical as well. I do think we'll run into challenges around just the basic ratepayer, the person who's just trying to keep the lights on a daily basis, right? How do you do that as cheaply as possible for them when you have this excess demand, and hyperscalers seeking to bring as much on as possible? So who's paying for it, and how will become front and center questions in the coming years.
Yeah, good point, Tom. I would say that we've been doing a lot of work with MassCC here in Massachusetts, focusing on the future grid and looking at things like demand flexibility at the edge of the grid. And people are talking about that, doing that with data centers now. So there's a lot of good innovation in that space too.
Very cool.
I'd encourage people to look out for that. The other thing I wanted to raise with you, well, just before I do, I'm going to say to the audience, I've got one last question to ask to the panel, but I don't see any questions in the Q&A box. So if you do have a burning question, please put it there, because that's the only place I can see your questions. We don't have a way to pass the mic. So please put your questions in there. But just to follow up that conversation, I think that you talked about interconnection, you talked about permitting reform. What do you think about what should companies do to make that happen, right? Should they be engaging, and who should they be engaging with? Should they be doing it on their own? Should they be engaging with trade associations to help get those reforms passed?
I'm a fan. From what we have a government relations practice at the law firm, so what we often see is trade associations. So, for example, in field, thermal batteries are actually part of the storage solution, and ours continue to receive credits, and then that's probably due in no small part to advocacy amongst many that are in that industry coming together under trade association. So I think the trade associations can play a huge role in getting some of these rules through. It's not cheap; it's expensive, and if you do it together, you are able to spread those costs out. And if you do it in a focused way, those trade associations can have a real impact. So, we've seen it. So I'm a big fan there.
Good. So last question before we see if there's any questions from the audience. And I'm going to point this one at Tom. So it seems that surviving in any time of change is all about adapting to those changes. So what are you seeing leading companies doing, and what would you advise them to do beyond what has already been said? So we've talked about a lot, but I'm sure you got more there.
Yeah, I mean, we've covered quite a bit. I mean, I really think about it from the perspective of how do you create some frameworks and processes, in order to adapt. And so, just having an understanding of your eligibility for, benefits or not, whatever kind of matrix that you can come up there. If you're in, climate, you're in solar, you're in wind, what does it take to have yourself be at construction readiness in light of, the need to try to, attempt to qualify on a more rapid basis? You have to establish like a bigger company, establish supply chain protocols, making sure that you're sourcing the appropriate, certifications, you're avoiding the foreign entities of concern, diligence templates, contracts, all of those things are going to matter more now, or as much, if not more. And then scenario planning. Well, what if I miss this deadline? What if, can we get a break from the IRS? Right, there are some exceptions for excusable delays. We're not entirely sure what that exactly means, but let's try to start figuring that out as part of our scenario planning. So I always say, plan for the worst and hope for the best, and, go from there. And so we are going to see overall a reduction in capacity, generation, but remember, IRA put us into an extreme, right, where we were, transforming the American energy industry and dramatically in a very short period of time under those rules. So yes, the pendulum swinging back, but it's not, going back all the way.
Thank you. Any additions to that, Kenyon or Katie?
Yeah, I can jump in as well. I think I agree with Tom, right? We've covered a ton on this webcast, and I think there's so much going on so quickly, that everyone in the market is really moving quickly, but also trying to think strategically. I think the advice that we would give is, if we think about the different parts of the subsector, if you're a developer and you had a pipeline of projects, particularly on the renewable side, is taking a really good look at that pipeline and see what can you accelerate, how much can you put into the next few years, right? And it's really that sort of race to completion of projects, almost like we saw when the production tax credits and the investment tax credits would sunset historically. We'd always see sort of a race to complete projects, and I think we'll see that in the course of the next 1 to 4 years now. But there's also that need to really step back and look at core capabilities, look at what your company does and how do we want to fit into the growth plan in the coming 5, 10, 15 years, and make sure that you have all the core capabilities that you need. I think when we saw, historically, there was, within the industry, just trying to tie it to some of the deals markets. In 2016, we had a banner year in power and utilities deal activity. It was the result of mega deals on the gas LDC side, so gas utilities. And a lot of that was ensuring that those that wanted to have access to that growth potential with shale gas and some of the upcoming expectations around the use of natural gas, the deals market was a way to sort of bolt on that capability. And so we talked a little bit about that before, Alistair, in terms of kind of looking at the deals market as potentially an avenue to bolt on some of those capabilities. I think we're seeing that now with the recent mega deal transactions, right? With the independent power producers looking at larger portfolios of primarily natural gas fired generation, it's bolting on that capability. But I think the deals market will continue to be that for probably the next few years. Those looking at core capabilities, trying to determine, do we need to add something? And the quickest way to add something might be a deal. So looking at the deals market potentially. So yeah, it's a very interesting time in the market where we're going to have a very short-term focus on building out some generation quickly, but we're also at the very same time having to think about how do we think we fit in the next 5 to 10 years, because you don't want to miss out on the opportunity. There's going to be a lot of people trying to get involved, and you want to make sure that you're the best position. And so ensuring that your company has all of those capabilities you need.
Thank you. Katie, anything to add to that point?
No, I think both, Tom and Kenyon nailed it as far as taking that step back. I think from our perspective, it's right in line with that. We want to make sure that we're communicating with these organizations as they're trying to figure out short-term, long-term goals, but also taking a step back and understanding what the current risks are and then what those emerging risks are. How are they approaching them and what's their risk appetite? in the short term and the long term, and that might be different, but we want to make sure that we're taking that approach as well so that they can be the best positioned, going into the future.
Excellent. We do have a question from the audience now, and it's something we haven't really talked about so far. We've talked about natural gas a lot, and we've talked about solar and wind, but there's another solution that is pushing to be part of the mix in the future, and that's hydrogen. So what do you think about the role of hydrogen in all of these different changes going on in the future that we see with lots of demand? Who'd like to take a start?
Tom, do you want me to go first on that one? And then
Sure, sounds great.
yeah. I think, I don't know, we've seen a lot of discussion around hydrogen. Clearly, there was some emphasis, particularly around the Inflation Reduction Act, to look at green hydrogen in particular and advance that. I do think there's a lot of potential for hydrogen. There is certainly some natural gas power projects that are looking at, can we use the dual fuel capability with natural gas and hydrogen as another fuel source. And I do think there is a lot of potential for it going forward. I think the interesting thing is it's more of that 10 to 15 year timeline in my mind. I think in the shorter term, we are seeing more emphasis around, traditional resources, traditional technologies, natural gas, wind, solar, battery. And so I do think that's going to be primarily the focus, Alistair. But I do think these other innovative technologies, we talked about nuclear before, I think hydrogen and green hydrogen in particular, definitely an emphasis and something that I think the industry is going to want to try to continue to evolve. But in my mind, at least from the discussions that I have, it does seem like that's maybe on the longer term horizon, maybe the 10 to 15 years, but could be a part of the mix at that point.
Yeah. Tom or Katie, any other perspective on that?
Yeah, I mean, the only thing I would add is, go ahead, Katie.
Go ahead, Tom. Go ahead.
Okay, I just thought, on a granular level, the new rules, reduced the clean hydrogen production credit timeline for projects. The sunset was 2032, now it's 2027. So it appears to be a pretty clear de-emphasizing of green hydrogen in the current political environment.
Yeah, and then just from our very similar, we've seen a lot of discussion and a lot of mumblings. Quite a few organizations that have been trying to develop green hydrogen, but at the end of the day, the economics right now are just not adding up. So I think longer term, if there's some advancements with the technology and a little bit more incentive, but as far as near term, as far as meeting that energy demand, we don't see a lot of hydrogen projects for the next 1 to 5 years.
Excellent. Well, I don't see any other questions, so I just would like to start wrapping up by saying thank you to our panelists. You've given a great demonstration of your expertise, and I think one of the things that you said was you're going to keep on updating people as these things shift. So look out for their advisory email blasts or postings on social media or web, etc., and we'll be helping with that. I think that, as we talked about just most recently, it's time to adapt, but you've got to be strategic as you do that. I think you've got to be a little bit innovative and look for new ways of doing things, whether that be in using different technology or in the way that you finance things or insure things, or and then look out for deals, right? Now, whether that is a deal to acquire some assets or to partner to make that happen, things are going to have to change. I think the common thing I think of in a thriving ecosystem is that as crises hit the ecosystem, you've got to learn to live in different ways and work with different partners and play your role differently. So it is absolutely that time to adapt. So fantastic advice. Thank you so much, Katie, Tom, and Kenyon, for answering so well. Thank you also to our state partners, Clean Energy New Hampshire, Maine Renewable Energy, and Renewable Energy Vermont. But also thank you to the teams behind us that have made this webinar work, to the team at ACT, Natasha and Hannah, to Tiffany and Brooke at Mintz, and to Jennifer and Gavin at PwC, and to Jim and Abby at Marsh. So takes a great team. Thank you again. And please know that we have recorded this webinar. We will be sending it out to all of the people who registered, and we'll be posting about it on LinkedIn as well. So thank you, and I think we'll end up here. Thanks again.
Thank you.